day. Welcome to another episode of Analysts Insights, your plug for everything investments, economics, and finance. I'm your host, Rufaro, and I'm joined by my colleague, Ranga. To start off with, we're going to look at interesting developments in the capital markets over the last week. We had an announcement from Treasury that in the near future, we may allow pension funds to invest up to 20% of their portfolios offshore. What do you think about this development, Ranga?
Thanks, Rufaro, and good day to our viewers. So, I think it's positive. It's just that this issue has been under discussion for quite some time now. So one would wonder why nothing has actually happened. But if this was to materialize, I think that would be some progress, because when you look at our local institutions, they are quite limited in terms of the universe of options that they have investing. So you are limited to investing locally. And then the problem is, obviously, you have got 100% ZIM exposure. And with what we have seen in the last 10, 15 years, if not 20 years, the hyperinflation and value loss, it means that all these institutions, every now and then, after a period of 5 to 10 years, there's some value loss that happens. So maybe just giving them a leeway to invest a certain portion of their investable funds into maybe more stable markets would provide some needed diversification. And I think it's good for the pensioners. At least you know that even as ZIM sometimes explodes, they'll have some sort of a backup or an asset that is returning some value. So this is something that needs to be done. And in any case, if you are all going out there looking for investors to come and bring their money into ZIM, I think it also makes sense for us to allow our investors to also take money outside. At the end of the day, we have to look after the interest of the pensioners who are the ultimate beneficiary of these funds anyway. So I think it's quite some progress. Maybe what's not clear is why has it taken us this long, and if there are any kind of time frames that are there in terms of how long we should expect this to happen, what kind of thresholds that they are working on, and what it means to the investment industry going forward. But yeah, I think it's quite some progress.
So I think what has been holding back this development is this thinking that Zimbabwe, being a developing country, needs all the capital that it can possibly garner. And it doesn't make sense for a market that is short of capital, that needs all this infrastructure to be developed, to be allowing its citizens and pension funds to invest offshore. So do you think that argument holds water? Is it wise for us to be letting pension funds ship money out when the current market is starved of capital?
Look, I think there's need for a balance, Father. So you want to ask yourself, what's the ultimate objective of any pension fund scheme? So you are trying to build an asset base so that you are able to pay out at the right time. So it's not so much about just creating a pool of funds that will be available for the local market as part of its growth agenda, but also you need to balance that with ensuring that maybe when these funds are needed, when these guys are going on pension, they've got something that makes sense to them. So if we just have a scenario where you create a pool that the local market can access without putting thoughts to the returns that will accrue to the owners of the funds, I think that's being very unfair on the part of the people who are making contributions. And I think there are so many markets that we can learn from where they are able to balance this. So the funds are available to meet their growth needs, but also some of them are actually being invested in markets which offer different return perspectives. So I don't think it's mutually exclusive that you can only have funds investing locally, and when you are doing that, when you can do that without having to look at opportunities that are available in other markets. So I think we have actually just let's look at the data and say, okay, over the years when we've actually insisted on having every 100%, every dollar collected being invested in Zimbabwe, are the pensioners better off? most of them have lost value. So there's evidence that maybe it's not the best option available. So maybe it's all about then saying, okay, what proportion of each dollar collected that you can maybe put into some investments offshore. So maybe for starters, it may be a number that's maybe lower than 50%, and then we see how that pans out. But that argument about having to invest everything so that we can support the local growth agenda, it's disingenuous to the extent that it's actually becoming a prejudice to the pensioners who are being forced to invest in a market where every now and then there are some shocks that actually undermines their value perspective.
Okay. Personally, I'm excited about technology stocks. I think if you look at the last 5 years, the big tech stocks like Apple, Facebook, Google, Amazon have added more than 500 billion to their market caps in the last 5 years alone. And anybody who invested in those stocks would have done extremely well. But the universe of global capital markets is very diverse. You can buy shares, both growth stocks or value stocks. You can buy derivative instruments. There's real estate. There are commodity products that you can invest in. So you used to be a fund manager once upon a time. If you woke up one day and you're managing a fund here and you are allowed to invest some of it offshore, what would your bias be? With all these choices, what would you would you stay away from? What would you find exciting?
I think the starting point is would be to look at the investment options that are here. So this is a developing country. So you find that most of our companies are predominantly into areas like resources and maybe some consumer stocks like your Deltas and things like that. But there's certain industry that we certainly don't have here. So it makes sense for some of these institutions to have exposure to them. Certainly technology. There's a whole lot of activities that is happening on the technological front, which is not represented on the our local markets. So certainly, if you could have an exposure in some of these high growth stocks that are techno linked, that would make a lot of sense. Obviously, I'll try to avoid resources. I'll try to avoid some infrastructure kind of plays because those are the kind of exposures that you can get locally. So when you are going outside, you are looking for something that you know maybe you may not have in Zim. So when you look at the universe of technology stocks that we have, pretty much you've got Econet and Cassava, and this is more like in the mobile telephone area and the services that they are offering. But out there, there are so many things that are coming up. Certainly in the last 5 to 10 years, some of the biggest businesses that have been created or that have actually come of age have been in the technology area, and that's exactly where one would want to have some exposure in. And also not only in terms of the industry, but also in terms of geographical diversification. Because I mean, like Africa, we tend to have some more or less sort of fundamentals that are close to each other. I'm sure what's happening in South Africa, which is certainly one of the biggest, the second biggest, one of the biggest economies actually in Africa, just tells you that Africa is Africa. So there's certain things that are common to all African markets. So you want an exposure in a market that is totally different from what you have here. So I think that is one of the things that I'll be looking at. And yeah, I think there are so many options in some of these markets that are innovative, that are promoting innovation, of which in Africa you don't get much of that happening. So I think that would be my sort of bias. I don't know what you think besides technology, anything else that you think can be exciting to look at?
Well, there's depending on your views, there's asset class called cryptocurrencies that has done very well for people who were early. I don't know whether the outlook is as exciting or whether anybody getting into that game right now would be getting into the top. But I think it would be exciting if fund managers locally had the opportunity to diversify their portfolios beyond Zimbabwe's borders. Speaking of moving money out of the country. Um, the other item in the news over the last week is the audit that's happening of blocked funds. There was a transition in 2019 from US dollars to Zim dollars at 1 to 1, and the Reserve Bank took on more than $1 billion of debt owed to creditors outside the country. And so two things come to mind when we think about this development. Firstly, there's an audit of these numbers, which vexes me because these numbers, these amounts were taken from the bank's balance sheets. So, my view is that the Reserve Bank had all the information it needed regarding exactly how much was due and to who. So, why 3 years later do we have an audit? And also, what does it tell us that 3 years later these monies haven't been paid to foreign creditors? Should foreign creditors be concerned and be contemplating writing down some of these amounts due to them? Are we actually going to settle these amounts in the near future, or are they going to be part of this big number of amounts due to foreign creditors that has been outstanding and continues to be outstanding for decades?
Yeah, so I think the issue there obviously is I agree with you that 3 years later, I think we should be talking about making these payments. So if you start interrogating each transaction there for whatever reasons, I think it shows some level of maybe confusion, some inconsistency, because the whole process was actually undertaken by the central bank, and obviously they are better placed in terms of being able to vet what qualifies and what doesn't qualify. And I think the longer it drags, I think the more confusion is going to be created, because now the debtors are not sure whether the central bank is going to make good its promise, but also on the other part, the creditors also for a long time they've been waiting. And I think just recently we saw from the Delta numbers that they spoke a little bit about that, where they're saying as far as they're concerned, that number is still on their balance sheet. Because as far as that transaction is concerned, the credit on the other side, they say my data is Rufaro. This arrangement that is there between Rufaro and their central bank, it's for them, it's not really of interest to them. So it means if the credit worthiness that's going to be put on the line there is your credit worthiness, not the one for the central bank. So the pressure is actually on the local debtors to make good on some of those amounts. And I think with the way the local currency is losing value, some of them are really seeing a scenario where every now and then there's some exchange losses that you have to book in. You can't deem some amount that has been shipped out of your balance sheet and then you forget about it, because suddenly that money is still due and payable to your creditors. So I think it's, if I were to advise someone whose funds were taken over, or maybe it's part of that legacy debt, I would say, you know what, but you still owe that money. Forget about these funds being settled by the central bank. Make plans and then see how it goes. Because now, do you think you go back to the same creditor or to the same supplier and be able to get a line on the basis that no, at the 20 million that I owe you, don't worry, the central bank is going to pay. It's not like that. I think for business continuity purposes, it just makes sense for some of these outfits to start making plans to be slowly paying. Should these funds then eventually become available from the central bank, you can then write them back as some sort of a gain. I think that's the way I look at it.
So if you are analyzing the balance sheets of some of our listed companies that have these creditors and accounted for them as settled because the Reserve Bank took them over, you would be advising them to write them back and to be making a plan to settle. So that does change the valuation somewhat. At a rate, depending on which rate you use, we already of the view that the market is overvalued. So if you then properly account for all this money due to foreign creditors, it actually means the market is much more overvalued than we think it is. So it's an interesting point. Speaking of other developments in the market locally, we've so far spent about $10 billion on grain. Do you think that this liquidity could be behind some of the momentum we've seen over the last week on the ZSE?
Yeah, certainly. Because these farmers, obviously, no one is quite comfortable sitting on Zim dollars. So once they are paid, of which is some progress that is there this year, that the GMB is actually paying them on time. I think payments are taking on average 7 to 10 days. But whenever a farmer receives their check or receives their funds into their account, obviously they would want to convert it into something. So to the extent that they don't want to be spending it as Zim dollars, most of that is going on to the para market rate. I think it also explains why the rate has actually moved from around 125, 130 to almost 140 Zim dollars per US dollar right now. And also on the local market, we have seen some pick up in terms of retail trades. I think the last bull run some 3 months or so ago was being driven by big amounts that were coming from, I suspect, from big contractors that were paying for big for services that they're offering to government. But right now, you're beginning to see some retail investor kind of flows coming onto the market, and I certainly it's being driven by that activity. And you have mentioned that 10 billion, and this is for about 400,000 tons of grains. The biggest portion of it is coming from maize, and if we actually achieve the 2.7 million metric tons that's being projected, it just tells you that we still have a long way in terms of extra liquidity that's going to be pumped onto the market. So at current level, probably you're looking at another 30, if not 40, 50 billion US dollars, Zim dollars rather, that's going to come from grain purchases by the GMB. And then if just 10 billion could cause this kind of movements on the power market and also the recent activity on the stock market, just try and imagine what the impact of extra liquidity would have on the markets. So I think there's actually some challenge, and we know that for the central bank, they've been trying to manage the reserve money or the money supply growth as a way to keep inflation at lower levels. But I think with all this liquidity expected to come in, I think it's going to be a very, very difficult one for them.
So does it make sense for us then to continue with this structure where we have a highly regulated grain market with one buyer that is basically being funded by the fiscus? Would we not be better off if we had a free market and anybody could sell grain and anybody could buy it? Perhaps it wouldn't have such an impact on the money supply.
Yeah, certainly I agree with you, especially now when we are expecting a bumper harvest. So I guess there's a certain level of the national grain reserve that maybe is required. So if it makes sense, maybe they would say that portion GMB would have to participate alongside other buyers to buy it for strategic reasons. But certainly you can't be having a scenario where every ton of grain that's going to be sold, it has to go through the GMB, because now we know that the government doesn't have capacity, and the capacity is also, so it's actually resulting in a lot of money creation, and especially when you consider that we are probably paying much higher than what average buyers of grain are paying in the region. It's actually creating. It's supposed to be a good year where we are not spending a lot of money into importation of grain. But if you're not careful, it may actually turn out to be to have some negative impact, because now we are printing to buy grain from the GNB, and we are doing that at inflated kind of prices. So we'll start having inflation problems, and so at the end of the day, we don't get to fully benefit from the having such a fantastic harvest, because now we'd have to deal with inflation on other issues. Because remember, we are not. It's not just maize and other grains that we need. There are some other commodities, but at the end of the day, their pricing is also going to be affected if we start have inflation being stoked by excessive liquidity coming from the grain purchases. So yeah, I think there is need to have that. There can be a strategic reserve, but at the end of the day, you need to allow other players to come in and buy the grain alongside the GMB.
Okay, moving on. There's a commodities exchange that has been announced. I think it's called the Zimbabwe Mercantile Exchange, which will basically be a platform for the market locally to trade in commodities. Did we not have such an exchange once upon a time? And does it change anything given that we've gone for so long without such an exchange?
Yeah, I think we used to have Zimes. I'm not sure if that is the right term, but it was some sort of a commodity exchange that we used to have, and it just died a natural death. I think maybe it may have been after the land reform. I'm not quite sure, but I think look, it's necessary to have that. I think it will sort of answer partly what we're discussing about having GNB as the sole buyer of grains, because now you've got a commodity as an exchange where some activity or transactions can take place both on the spot and also on the futures market, which is quite important also for the farmers to have some sort of a futures market where you can sell your product now. Whatever output you're expecting in the next harvest, you get to contract to sell it before that happens. And so, look, and certainly for us as market players, it's an extra market. We are happy to have that alongside the markets that we already have, like FinSoc, like the ZSE, and also the VFX. So I think there are a lot of, there's still more information that we need to get for us to really have a better judgment of whether this is going to be a success or not.
Speaking of markets, there's been a bit more momentum on the Victoria Falls Stock Exchange. We saw the listing of Padenga, and there's talk of listing of Caledonia and Invictus. Do you think that the mood in our local capital markets has changed vis-a-vis our views of VFX? Because I think when it was launched, the consensus was that it was a white elephant. So have they done a good job in terms of getting the market to take them a bit more seriously? And do you think that this is we're entering a golden age for the VFX?
I think so. There was a lot of skepticism when the VFX was launched, and certainly for a long time there was just Seedco, and the absence of the likes of most like Old Mutual and PPC was such a big issue. And I think having Padenga there was a big deal, because obviously Padenga, it has got some very significant following, and also when you look at the major shareholders and the fact that they are big capital market players, you expect to see a lot more activity, and also even the coverage. I know there's a lot of coverage on the likes of Padenga compared to what you have on Seedco, and coverage actually moves the needle in the capital markets because information is actually put out there to potential investors. And then to have this news about the likes of Caledonia and Invictus, I think this should be quite some positive news in the sense that you want mining businesses. This is actually something that's lacking on the ZSE right now. We don't have any mining businesses of cloud. So if some good mining names are to come on the VFX, certainly we might see some activity there. But yeah, look, it's still a long way, but certainly some progress that's happening there.
Thank you so much for that, Ranga. And on that note, it brings to a close another episode of Analyst Insights. I hope you enjoyed the show. Please don't be shy with your comments and suggestions. Thank you so much. Cheers.